Hello and welcome. This is the Insurance Pro Blog Podcast. I am Brandon Roberts.
And I am Brantley Whitley.
And you are listening to the internet's favorite podcast about life insurance.
Yeah.
Favorite podcast about life insurance that wants to tell you should probably buy more life insurance. And if you want to buy more life insurance, you should go into the insuranceproblog.com, click on the schedule a call, schedule
you
something.
can do that. You can contact, you can write us a message. You can do one or the other. If you go to the insuranceproblog.com, there are multiple ways that you can get in touch with us to tell us, hey, I'd like to buy some more life insurance.
If you go to that website and tell us, I can't figure out how to contact you, there is a problem. And it's not our problem anymore. At one time, we could take ownership of that, but not today.
Right. It has been re-engineered.
Not today.
Wait a minute. Let me use the right word. Reimagined. Been reimagined.
Ooh. This is why you are the director of online marketing.
Yes. I've been knighted.
I'm just the guy who named it the Insurance Pro Blog. So
yeah, you get all the credit.
I'm the idiot.
Yep. You get all the credit. All right. So
speaking of life insurance.
Yeah.
We would like to tell you why it is so whiz-bang nifty and better than bonds.
Yeah, that is sort of the slant of today's episode, is it not?
Mm-hmm. Mm-hmm. It is. And we have definitely dedicated some time to this discussion in the past. But the big element or the big focus today, and I'll be honest, like we've talked about this casually in before, and I didn't really realize that there are actually 3 different academic pieces of work that all drew basically the same conclusion here.
So we weren't just imagining it, in other words.
No, we just need a 4th. That way I could say we were drawing together the 4 horsemen, but sadly that's not here. So there's 3. One of them, I don't know, fell off the wagon or something, but fell off his horse. So just to lay some groundwork on something that we think is common knowledge, but we get lost in the world or rather we get lost in the depths of the industry that we already work in and think that everybody just kind of knows what we find as common knowledge. And we're very, very wrong about that. So people really, in general, don't have a solid understanding of the risks associated inside bond investing.
Right.
Now we would stand here and say, well, I mean, the Bond Index episode is well over 10 years now that we uttered those words. But
it only took like 10 years for it to manifest, but yeah.
It's really hard for information about the Bond Index to get out there when there's only 5 people listening to your podcast. So we'll admit.
Should we summarize what that whole thing was about?
The whole idea is when you buy bonds, there is a market value to your bonds. So if you buy a bond, you pay a specific price, and tomorrow you can sell your bond. But the price that you'll get for that bond is dependent on what happens with interest rates.
Yep.
So if you buy a bond and a day later, a week later, a year later, whatever it is, interest rates have changed from the level they were at when you bought your bond, that is going to affect the price you would be able to sell your bond at.
Right. So let's just use real numbers. Let's say you bought $10,000. You bought a bond that was $10,000. Mm-hmm. Okay. And it was paying 5%.
Yep.
And then, we're going to get into so many specifics that I don't want to get into because it's going to depend on what type of bond is it and how long is it for and what's the duration.
Well, we're going to oversimplify here. Don't worry about that. We're going to oversimplify. So how much later do we want to talk?
Let's just say
6 months?
6
year
months,
later?
Year, doesn't matter.
Okay. All right. Interest rates have gone where? What do you want to use for the example?
Interest rates have gone down.
Okay.
So now you can buy the same, let's just assume it's the same bond. 6 months later, you can buy the bond for the $10,000 bond is paying 4.5%.
Mm-hmm.
Well, guess what? That means the value of your bond that you bought at 5% is worth more than $10,000 in the open market.
Correct.
Because it has a 5% coupon attached to it.
Yep.
So it's going to be somewhere, you're going to have what's called a premium, which means you could sell it for more than $10,000 that will have the yield. The coupon doesn't change. That's fixed, right? But the effective yield will be something closer to 4.5%.
Mm-hmm.
So that means you made money. Now,
yep.
What if the interest rates
just to call time out for just a second? Just call time out for just a second. Which, for an older segment of the U.S. population, is what happened for the majority of their adult life.
Right.
So, baby boomers, yes, and Gen X kind of lived in a world throughout a lot of their adulthood where interest rates pretty much did nothing but go down. And so bonds, bond funds, and all of that stuff seemed like it was super safe and it never, ever declined in value.
Yep.
Because from that exact thing was taking place.
If you pulled up a chart of, say, 10-year treasuries or something, I'm just trying to think of something generic, and had a chart of interest rates on the 10-year from 1980 to 2021, it's a general trend of down.
Yep.
Way down.
This is true. Okay. Now we want to talk about the inverse of this. That's where you were going before I cut you off.
I was just saying, come inversely, if it's gone up to 5.5%. So that means people can go out on the market and buy a brand new bond, $10,000 bond, and it pays them 5.5%. Then your bond that only pays 5% is worth less than $10,000 on the open market.
Right, because nobody's going to want your bond at 5 if they can buy a new issue one at 5.5.
Right.
So you have to give them a reason to buy your bond.
Right. So you got to sell it for something less than $10,000 to get them closer to 5.5. That's how it works in general.
So the bond index, which I think we recorded in like 2012 or 2013.
Yep.
That discussion all came about because we were at a very unusually low level of interest at that point.
And had been.
Yep. This was in the shadow of 2008.
Yep.
Interest rates were brought down rapidly. And we were sitting there saying, I don't think we're going to stay at these levels for a long time. And if we do nothing more than regress to a long-term mean, there's going to be a pretty substantial increase in interest rates. And that's going to spell trouble for people who are buying bonds right now because there is going to be a reduction in value.
Right.
And so
many of them, by the way, many of them are going, the sort of thought process is, many of them are going to want to sell these because now they can buy new ones that are paying more. You know, people were, I don't even remember what interest rates were back then, but let's just say a 10-year treasury was what, 2%? If
that.
And if interest rates go back up to 5%, no one's going to want to hold 2%.
Nope.
They're going to want the 5%.
Yep.
But they're going to have to sell it for less than what they paid for it.
That's true.
Which most people don't realize. I mean, most people don't think bonds go down.
No, and I would dare argue that younger generations are going to have a slightly different outlook on this because now they're living in a world where we have seen interest rates go up and we've seen a dramatic drop in bond values in a very recent time period. So they'll probably hold on to a different feeling about this. But there are older generations that just remember this constant run up in bonds. Like Pimco, Bill Gross, his career was created from this.
Yep. Right place, right time.
Exactly. So that trend long term led to this over safe belief about bonds. Now, again, our thesis back in 2012 was this won't last, interest rates are going to go up, and people are going to lose money. And it turns out that there was a lot lower levels of inflation that persisted through the 20 teens than we assumed, and so interest rates had no reason to go up. But when we finally found ourselves,
the Fed out there buying bonds all the time, keeping interest rates low.
Yeah. When we found ourselves in a position where interest rates were going to go up, we saw a massive decline in bonds. Yeah. And we've also experienced a lot of bond blahness, because interest rates have remained at a level where there's some hesitation to buy in, and two important things. So the majority of people who invest in bond funds, not bonds directly themselves, because
ETFs or mutual funds.
Difficult to buy bonds directly issued. Now, one of the arguments if you do. So you can buy municipal bonds kind of easily, and you can definitely buy treasuries yourself easily.
For sure.
So you could buy those things and you could just hold them to maturity. Yep. And a lot of people will lie to you. There are financial advisors who say this, and it seems almost like a violation of their duty to say this. But lots of times they will claim that, well, if you just hold to maturity, you don't lose any money. And in a nominal sense, okay, fine. But technically speaking, whether or not you are marking your bonds to market or your brokerage account is, you still, from a liquidatable point of view, lost money.
Right.
Like if your plan is to buy a 10-year treasury and hold it to maturity, yes, you're going to collect all of the income and get back your principal. And in your mind, from a nominal perspective, you're going to say, well, that was safe and I didn't lose any money. But if 5 years in, interest rates are higher and you find yourself in a position where you need to liquidate positions because you need money in a bad way, guess what? You may not realize you've lost money, but you're going to find that out when you try to sell your bonds.
Right.
Now, there's that class of people. But again, the majority of people who invest in bonds, retail investors, are buying bond funds. And this thing that we're talking about, that we just spent 10 minutes illustrating for you, is the thing that causes bond funds to decline in value. Yep. So if we look at like 2022, when bonds in general, if we look at them in kind of aggregate index or indices, we're down like 13%.
Right.
13% was the decline of the allocation of your portfolio that you were supposed to be using to protect you against the losses you would face in stocks, which, oh, by the way, were down almost 20% in 2022.
Right. Yeah. I believe, I know you're younger than I am, and you came along a little bit later than I did with starting your career in this world that we live in, this financial services world. But the training that I got was very, very, very explicit. And that was the reason we use bonds is because they're inversely correlated to stocks.
Yep.
Which is true, except when it's not.
Well, the theory as far as
the truth is they don't have anything to do with one another, really. And that's the true part about the inverse relationship is that it's not really inverse at all. It's just disconnected. They respond to a different set of circumstances.
Yeah, and there was also one sort of theoretical explanation for why they might move in opposite directions, and that had to do with the business cycle. So if the Fed starts to tighten, interest rates are going to move in a way that hits stocks harder and possibly favors bonds as it comes out of that tightening cycle and then drops rates. So we see stocks decline, the Fed takes action, and so the bonds that you might be holding are going to be buoyed by that because of the drop in interest rates. But it turns out it does not work in a perfect lockstep fashion.
Right.
And it's absolutely the case that there's going to be a decline in bonds in the meantime that most likely are not going to recover the losses, even if we get the boost from interest rate drops.
Right.
We could argue that the losses sustained in 2022 among most bond fund holders have not necessarily gone back to positive yet.
I was trying to do that
bond
math.
funds have
I was trying to do that.
languished.
I was trying to do that math in my head. I was looking at one that's an aggregate, it's not duration specific. It's just the biggest one out there. You'll know what, I'm not going to say the ticker, but by my math, no, has not come back.
Yeah. I think I know which one you're talking about. We can be odd about not mentioning them for the sake of avoiding what people would think is a recommendation. But somewhere in the $85 per share price before the fall, still sitting at about $74 per share 5 years later.
Yep.
So hard to make that back up when the upside is limited as is usually the case with bonds. And you also don't have a massive, massive reduction in interest rates that has materialized.
No. No.
I mean, we saw in the 90s and then the 20-aughts two gigantic interest rate reduction policies.
Cycles. Yeah.
Yep. And that has not materialized as of yet.
Mm-hmm. Even though we've had some lowering of interest rates, the yields bond yields have not reflected that, generally speaking.
Right. So the problem is bonds are not necessarily a flight to safety. They are an alternative asset class that is income focused, and that's good for what purpose it applies to.
Yeah.
But it doesn't mean that it will be a substitute for stocks from a safety perspective.
Right.
Now, there have been a few different third parties. Some have insurance motivations, some do not, that have analyzed the substitution of bonds for things like whole life insurance and annuities to try and to ask the question, could you accomplish the same thing or better if you use these instead of bonds? And all three of them basically say yes.
Right.
The timing of these, do I have the dates? Probably not. Not on this one. I don't remember when the Ernst Young one came out, but it was a few years ago now.
Mm-hmm.
And their analysis, they would be the accounting firm that I mean, they're not an insurance company. So their analysis was looking at the use of stocks and bonds versus stocks and whole life insurance, or stocks, whole life insurance and annuities, or stocks and annuities to determine, okay, can you create more income and more long-term account balance value if you sub out bonds for life insurance or annuities?
Right.
And the summation of their research is, yes, you can do that.
Mm-hmm.
And you can do it if you allocate something like 20 to 30% of your savings budget to life insurance.
Mm-hmm. Mm-hmm.
And you eliminate the risk that is associated with bonds, because whole life insurance does not participate in the mark to market when interest rates decline.
Right.
Insurance companies do. That is a part of their accounting, and it does impact them. But policyholders do not see a change in cash value because interest rates have changed.
Right.
And insurance companies are large aggregators of risk, and they can absorb the problems that would be associated with interest rate declines for a couple of different reasons. One, they're institutional investors, so they get better deals when they buy bonds than you and I do.
Sure.
There's more padding to deal with the changes of interest rates for them.
Yep.
They can also diversify the risk of how price movements will take place in certain interest rate movement situations. So they can buy different style of bonds to deal with interest rate movements and smooth out the rate at which prices will move unfavorably to them.
Yep. And they can hedge those risks too. So.
Yes, they can hedge those risks. And they are absolutely going to hold the bonds to maturity. They never sell them. So, okay, we already covered that from a liquidatable standpoint, that still technically means you've lost money. But from the insurance company standpoint, they need the income to cover the contractual guarantee that they've obligated themselves to.
They're not looking to sell them.
Mm-hmm. So the decline in value it's not a zero problem, but it's a very, very tiny problem, because the whole reason to buy the bond is to collect the income to create the cash in the policy in the first place.
Sure. And the way we saw it manifest in whole life insurance anyway is we had dividend rate decreases over that.
Yep.
What would be the time frame? 2008 to the early 2020s?
Yeah, the early like 2021, 2022 time frame.
Yeah.
Was when it finally, we stopped seeing dividend scale reductions and we started seeing dividend scale increases.
Right. So that impacts what you earn on your cash value, but that doesn't impact your cash value directly, as in
Yes.
like a decline in your cash value.
Correct. So then it really does become an asset that you hold that hedges against the possible loss of stocks.
Right.
And the upside to that is you don't have to sell stocks at a time that is extraordinarily inopportune because they've gone down in value.
Mm-hmm.
And it turns out, when it comes to stocks, not bonds, but stocks, if you face a substantial drawdown in stock values, you don't need a whole lot of time to recoup those losses.
Right.
It's not zero, but it's not a massively long period of time for the most part. And owning something like life insurance to buffer in those moments helps that recovery along even further.
Yep.
The next piece of research is a few years old, but it was put together by Wade Pfau at the American College, which is a very much insurance industry funded institution.
Mm-hmm.
So understand that possible bias. And Wade Pfau's research really, it looked at the idea of financial planning and retirement income strategies that have been around for decades that basically say, look, if you have this asset, or excuse me, you have this portfolio and you take a certain withdrawal rate, we can do an analysis, we call it a Monte Carlo analysis, that basically gives us a rough estimate of the probability of success or failure.
Right.
And then we have to set our tolerance. So what percentage of failure probability are we willing to accept to say, okay, that's a viable strategy to pursue? But within that style of analysis, we're going to see the failure data points. And so what Wade Pfau set out to do was basically ask, well, all right, if we take those examples of failure those failure scenarios, and we swap out life insurance for bonds, do we improve the results to the point where they're no longer a failure scenario? And the answer is yes. And it's a resounding yes. In fact, the research that was used pulled the results from several different multi-year tranches to look at, okay, certain withdrawal rate, 60-40 bond portfolio, where does it succeed, where does it fail? And the absolute worst time frame was 1962 to 1995. In that scenario, you run out of money. By getting rid of the bonds and putting whole life insurance in place of the bonds, the ending portfolio balance over that same time frame is $2.26 million.
It's better than zero.
So we go from zero, we failed. We ran out of money before we got to the end of the time period, to now we have a $2.25 million surplus because we had life insurance that was used as the backstop to losses versus bonds.
Right.
And the very other interesting piece here, so that the strategy was, we'll lean heavier on whole life insurance in the bad years. So when we see our stocks go down a lot, we're going to withdraw more money from the whole life insurance policy. And it turns out there were only 3 years in that entire span, the 1962 to 1995, where we needed to very heavily lean on whole life insurance to get this result.
Yep. It's pretty incredible.
Mm-hmm. The kind of mind-boggling observation here is that we can use whole life insurance not to make your life wildly better than you thought it was going to be. That has never been our thing here.
No.
But what we are doing is we're introducing whole life insurance to make the bad situations far less bad.
Exactly.
And that's the critical piece that we've been talking about for all these years that still some people don't get. I can't make your life better per se. Stocks are still going to win in an absolute drag race rate of return. But what I can do is I can make the horrible nightmare scenarios far, far less problematic.
Yeah. Well, that's the whole thing. Like that, we finally found the evidence to support what we've been trying to tell people for all this time. You know, from a third party, I feel like we've we've provided a preponderance of evidence, but
yep.
No one believes you when you're the one that creates it. It's just proof to me what we've been trying to say, which is these are all just tools. The equity market's a tool for you. The bond market's a tool for you. Life insurance is a tool. Annuities are a tool. Real estate is a tool. Owning a business is a tool. Those are all financial instruments, so to speak, even if they're not in the traditional sense. They're all different buckets and they all serve a purpose. When you get yourself in trouble is when you're expecting one of these to perform a job that it wasn't intended to perform.
Mm-hmm.
And that's what true diversification is all about. That's what we've been trying to say for years. It's not about, having, small caps and large caps and mid cap. Fine. That's fine. Not arguing with that. Okay, great, wonderful. But
it's not diversification.
True diversification is having lots of different things that are truly not correlated.
Mm-hmm.
They don't react in the same way under the same conditions.
Hey, I got a question for you.
And that's true. Because the stock part of the Pfau piece is crucial. That's the growth engine of the whole thing, right? Over time. In other words, this couple that only experienced the 3 down years between 62 and 95.
Yep.
If there were no stocks, there would not be 2.26 million at the end of the day.
Nope, it would not.
So
it would not.
Anyway, go ahead. Sorry.
And that the stocks played a much bigger role in getting it to 2.26 million.
Come on. Absolutely.
Yep. So I got a question for you. You and I both have investment portfolios that are not just life insurance.
Right.
And you and I also are involved in other people's lives who have investment portfolios. You more so than I. But we over the past couple of months, there's been some volatility, shall we say, in the stock market. So over the past couple of months, the portfolios that we are aware of that have stocks in them, account balances are I would dare say across the board worth a little bit less around now than they were, like, let's say, a month and a half ago.
Correct.
Yep. The whole life and index universal life insurance policies that we've put in force, many of them, those account balances are a little bit more than they were a month and a half ago.
Agreed.
Across the board.
Mm-hmm.
The volatility has had zero impact on them.
Right.
None of the insurance clients have called us up voicing their concerns about what's happening with the cash value of their policies in the face of this recent volatility.
No.
Because it doesn't happen. And the stuff that you and I are typically involved in when it comes to, let's just say, more stock market-like investments, has a decent amount of bond exposure to it.
Right.
And income style exposure to it, which has all been hurt by this recent volatility move. So again, they are not moving in inverse directions. They're moving together, stocks and bonds.
Right.
So the safety play doesn't exist. But when life insurance is incorporated, the safety play absolutely exists. The last piece of research, which is old, I remember this when it first came out, and this came again from Wade Pfau and this time Michael Kitces as a collaborator. And kind of the major finding from this is the paradigm that as you are younger, you need to be much more heavily invested in high risk equities is not necessarily the winning strategy. And instead, the data supports a lower allocation to high risk style equities when you're younger and ratchet up that exposure as you get older.
Mm-hmm.
Which is actually something we've advocated for a little subtly for years. To note that, look, if you at first build a basis of somewhat safer assets, and of course our favorite one would be life insurance, then you are putting yourself in a position where you are well capitalized to deal with problems. And then once you have that all sorted out, you can go crazy with the riskier stuff.
Right.
Because when bad things happen, not if, but when, you've got this other position that makes you care less about what's happening inside the riskier part of your portfolio.
Right.
So it's not the case that as a young individual, you need to go 100% equities because there's this very, very wrong suggestion that time eliminates risk.
Right.
Which, no. Just no. The longer you have to invest, the monstrously higher the probability is you're going to deal with some drawdown.
Yeah. And it's going to hurt a lot more when you got $1 million than it does when you got 1,000. A lot more.
Yep. So if you build the more stable part first, the way that those drawdowns impact you is going to be less, even if they come later and you've got more money.
Right. Well, the thing is, it'll still hurt emotionally and psychologically. Always. Like, no one likes losing money, no matter what. But it has, if you do the inverse as the finding suggests, right? Which is, I'm calling it the inverse because it basically is flipped upside down.
Yeah.
By the time you are older and you've increased your risk exposure, so to speak, you have a very stable base that's not subject to volatility and thus not as capable of impacting your life in a real way. And at the end of the day, that's really all we try to do.
Right.
Is how do we help you set things up so that you can keep living your life? The market's going to do what the market's going to do. The value of all your assets is going to do what they're going to do. But how can you set things up in such a way that whether things go up or down, it doesn't have any real substantive impact on your day-to-day living? And I think that's what most people want. I think most people don't know how to articulate that. But
well, I'm sure you've observed, I know I have, people who will move to cash when volatility is high.
Absolutely.
And cash is a sure way to not see your account balance go down.
Most people don't go there till it's already gone down, but yes.
Well, I mean, that's the problem though. That's the problem, right? Like it's if they were sitting on the cash beforehand, everything's great, but I don't want to sit on cash beforehand because the return on cash isn't that great.
Right.
The return on whole life insurance versus cash is considerably better. So you could hold that and then not have to move to it because you don't really care that the stock portion went down. So a lot of people, they try to make a move when it's too late. But if you preempt all of this by setting yourself up correctly ahead of time, you don't have the same problem.
Right. Exactly.
Okay.
Is that all you
Anything
have to say
else
about
for today?
No, I think we've...
that's all I have to say about that.
Good. Don't forget to visit the insuranceproblog.com for lots more information on this sort of subject and many, many, many others. We've reorganized it so it's much easier to navigate now and find relevant topics sort of clustered together. And we've showcased some of the things that we think are the best. So go over there, check it out. And if you'd like to talk to us, reach out, send us a message or schedule a time to talk.
That's the insuranceproblog.com for the newly joining us folks.
All right.
And with that, I am Brandon Roberts.
And I am Brantley Whitley.
And we will see you next week.